Billions of dollars are flowing through the exchanges right now, yet the headline numbers remain in a state of high-velocity stagnation. Prices flicker with intensity, but the actual direction remains uncommitted. To an active trader, this rapid fluctuation looks like an invitation to find an entry point. However, these specific conditions historically precede a cycle where retail capital is absorbed by institutional weighting. Beneath the complex algorithms and ticker tape, the market is currently communicating a very specific tension. It is a stalemate between immediate fear and the long-term desire for growth. This balance scale shows the data behind that stalemate. While banking stocks are providing enough lift to prevent a total sell-off, IT and mid-caps are providing an equal amount of downward pressure. If you feel hesitant about making a move today, you are accurately reading the data. When major sectors provide these kinds of perfectly opposing signals, the probability of a false start in either direction increases. This environment is built on internal friction. When the market's primary engines fight each other to a standstill, the resulting lack of momentum often serves as a warning of a larger structural trap for the impatient. The primary risk is a price action that settles into a jagged horizontal channel. The market is moving sideways. Notice the sharp decline in the volume bars below. Institutional players have moved to the sidelines, leaving only small, erratic spikes of retail activity. Without institutional weight to provide a clear floor or ceiling, retail investors find themselves operating in a vacuum where small trades cause large, meaningless swings. This environment exploits a deep psychological bias. When humans observe a stagnating portfolio, the biological urge to correct the situation through action becomes difficult to ignore. A sideways market functions as a pressure cooker for that impulse. It is an environment that effectively drains capital by baiting investors into making moves before a true trend has been established. This period of indecision is being sustained by three specific macroeconomic forces working in tandem. The first factor involves global cues. Volatility in international markets creates a feedback loop, where uncertainty in one major economy forces traders elsewhere to pause. The second factor is the expectations surrounding interest rates. The looming possibility that rates will remain high for a longer duration creates a ceiling on growth expectations, keeping buyers cautious. Finally, there is the impact of profit booking. After any period of gains, many traders sell their positions to lock in cash. This constant selling pressure effectively caps any attempt at an upward breakout. The collision of these factors creates a thick layer of analytical fog. The usual signals investors rely on to make informed decisions are effectively obscured. This environment forces the participant to rely on guesswork rather than strategy, which is the exact moment the market trap begins to close. History shows that the mathematical toll of trading during these periods is often higher than during a sudden market crash. Look at how capital behaves on this chart. The balance is eroded through a sequence of small, repeated losses, the cumulative effect of brokerage fees, slippage, and entries that happen just as a minor swing reverses. This represents a silent transfer of wealth. Every impatient trade executed without a clear trend effectively moves capital from the retail participant to the patient institutional players waiting for clarity. A crash is a loud, obvious event that prompts immediate defensive action. This sideways erosion is quiet, making it harder to detect until a significant portion of the portfolio has been drained. The primary risk factor in this scenario is the internal drive to trade. The market provides the environment, but the investor's own compulsion to act is what ultimately triggers the loss. Surviving this period requires a counterintuitive approach. In a sideways market where the probabilities are stacked against a clear breakout, the most profitable move is often to remain inactive. For long-term investors, the strategy remains focused on gradual accumulation. Small price dips can be utilized, but capital should be deployed in stages to avoid overexposure to a single price point. Short-term traders should consider avoiding aggressive or leveraged positions entirely. In an uncertain market, leverage acts as an accelerant for the erosion of capital. When the data is contradictory and the institutions have stepped back, remember this fundamental rule: not trading is a trade. Wealth is built by preparing for the moments of clarity that follow the chaos. Smart investors focus on their long-term goals and quality assets rather than trying to outguess a directionless market. Investing is a discipline that rewards the calm. When the signals are mixed and the noise is at its loudest, the most disciplined mind is the one that secures the win.